It's often said that 24 hours is a long time in markets, and we've got a great example of that this morning. Yesterday morning, we were facing disaster. The conflict in the Middle East had sparked a huge jump in oil prices. They went from around $92 a barrel to $117 yesterday morning. And of course, the reaction in share markets was huge. We saw pressure across the Asia-Pacific region. Australian share market was down 4.5% at one stage yesterday. It did rally back to finish down just under 3% down. But the pressure across the region was very noticeable. And in places like Taiwan and Japan, that pressure resulted in even bigger falls, with the Japanese market down almost 7% in trading yesterday. However, over the course of the evening session through Europe and the US, a lot of that concern was moderated. We had some news flow. The president of the US said that the war is very complete, whatever that means. And the G7 held an emergency meeting where they announced that they would release strategic reserves of oil in response to the spike in oil prices. And both of these announcements combined had a very calming effect on markets generally. Oil prices dropped right back. This morning, they're trading closer to $85 a barrel, having taken back all of those gains from yesterday and more. And share markets in the US rallied. The Nasdaq was up 1.4%, the S&P 500 up 0.8%. The Russell 2000 was up 1.2%, showing just how broad the rally in US shares was. And although, in my view, we definitely don't have it all clear yet, it certainly seemed that way, particularly given the performance of some stocks. SanDisk was up 11.7%. Broadcom, one of the magnificent eight, if I can put it that way, up 4.6%. And this support for the market-leading stocks in the US is in direct contrast to what we saw across the Asia-Pacific region. But locally here in Australia, BHP shares fell another 5% plus in trading. So it does appear we've got a world of two halves at the moment. Having seen that rally, though, it's pretty clear from the level of the volatility index that we have not got a green flag yet. It fell from those levels around 29.5, that is levels that we hadn't seen in 12 months, fell back to 25.6%. Remembering that we see 20% as the rough rule of thumb. Above 20%, concerns are still very real, and that's where we sit at the moment on the VIX. However, it's pretty clear risk appetites have risen with that drop in the oil price. Bitcoin up to 69,000 US dollars. The whole crypto complex getting a lift, and 10-year yields around the globe rallying. So in the US, the 10-year fell from 4.16% to 4.09%, and that should bring the Australian 10-year yield back today from those highs just below 5%. Now, 5% is a line in the sand for Australian 10-year bonds. If we see them rise through that level, that will be a clear sign about a deteriorating sentiment environment based on rising inflation. But at this stage, it looks like we'll pull back from that danger zone in trading today. We do have some data out today in Australia. Consumer confidence and business confidence will be released in the morning session. And tomorrow, as part of our Moomoo Daily, we'll be doing a wrap of the Australian earnings season. Tune in for that one. It's very clear, though, at the moment, we still have some investor caution, despite those comments from the White House that the war is very complete. The key issue, of course, is the blockading of the Hormuz passage. And Iran has reissued its warning that no ship is safe in the Straits of Hormuz. So under that scenario, we've got a very different narrative coming from the US and coming from Iran, because the Iranians yesterday elected the son of the assassinated Ayatollah as the next leader of Iran. And that does not gel with the narrative of regime change that's been coming from the US. So this will be resolved one way or the other. Certainly the US and Israel have the firepower, but the actual damage done in waging this war might be more important than the eventual victor. Certainly a good reason for investors to be careful about how they respond to the action overnight. And it's the underlying issues that could come back and bite the market. So, for example, on Wednesday night, we've got US CPI. And then on Friday night, we'll see the national accounts numbers, the GDP growth data and the deflator, that the Bureau of Labour Statistics uses to calculate it. And both of these speak directly to inflation. Now, on Wednesday night, we're expecting readings at both the core and headline level at 2.5%. Any significant deviation from that will almost certainly have a huge market impact, particularly if it's significantly higher than that 2.5% estimate, because that destroys the whole narrative around the idea there might be Fed rate cuts. And if that's the case, the market reaction in shares could be significant. If, on the other hand, we see inflation come in well below those levels, that will fuel further rate cut expectations. And let's remind ourselves that at the moment, US markets pricing 1.5 25 basis point reductions over the course of this year. If we do see inflation much lower than that 2.5% forecast, that could see expectations of rate cuts rise and would likely bring support to the share market. So something to keep in mind, it's not just about the Middle East. The Middle East is very important to the short-term market outlook and possibly the long-term outlook, but there are other factors in play. So we'll be watching that data Friday night, because one of the key fears that's coming out of the Middle East is stagflation. And although this data comes from before the outbreak or the escalation of that conflict, if it shows a trend in that direction anyway, that could be concerning. In other words, if growth rates fall and inflation, as measured by the deflator on Friday night, rising inflation, falling growth is a recipe for stagflation. That would set market fears running once again. Now, the other key sentiment driver before this escalation in the Middle East was the questions around AI and its impact on earnings at various companies, and whether or not it would be a positive or negative for particularly tech companies. Now, we've seen a tech-led rally, and we're about to see some of the granddaddy tech stocks report. Oracle and Adobe are about to release their results. And of course, they also speak directly to the impact of AI and could be very important in terms of how the market thinks about the impact of the new technologies. So plenty to keep an eye on at the moment. Certainly a good time for investors to be paying close attention. And one of the reasons for that is all the opportunities that are coming with the huge moves we're seeing in stocks. Now, those huge moves can represent much higher risk levels, and investors and traders must bear that in mind. But for example, yesterday we saw Paladin, a locally listed uranium miner in Australia, Canada and Namibia, down 8%. And the global sector sold off over the previous few trading sessions. But overnight, we saw US uranium stocks bounce back as a subsector, up 5% in overnight trading. Paladin is up 16% year to date, despite yesterday's sell down. Its full year earnings growth is estimated at 47%, but it's not just about that gross number. This will be the first year of consistent profit for Paladin. And this means it seems to be getting its production house in order. In other words, Paladin seems to be transforming from an explorer to a producer. And that, of course, changes the investment profile and could mean a re-rating from investors for Paladin. Along with Oracle and Adobe, we've heard from Hewlett Packard. It reported this morning after market. Now, it was up 3.2% during the trading day. There was clearly anticipation of a good result, and it appears that's what they've delivered, because in post-market trading, Hewlett Packard surged by more than 5%. Now, it's since given up a lot of those gains, is now trading up about 1% in addition to the day gain. So perhaps there was a little over-enthusiasm there, but nonetheless, it does appear the market is pleased with its result. And certainly in terms of the first quarter EPS at 65 cents was well above expectations. Their revenue growth at 9.3 billion was below expectations. So we've got a picture here of sales slowing, but efficiencies increasing. And the company, Hewlett Packard, also guided analysts higher for their second quarter estimates of earnings. And that's usually a positive. They've seen strong AI PC growth, and Hewlett Packard is down 10% year to date, but up 40% over the last 12 months. So it might be seeing in share price terms a pause before resuming an uptrend based on this improving earnings profile for Hewlett Packard. And the last stock on our watch list today is Live Nation. the huge events and ticketing group based in the US. It was up 6.2% in overnight trading. Once again, extraordinary moves in these large cap stocks, and largely on the back of news that had settled a US antitrust suit. Now, there will be a cost to settling the suit, including a $200 million payout. That will need to divest some venues. And as part of the agreement, it looks like they're going to open their ticketing platform to other sellers. But with this out of the way and the fact that they did not have to split up the company, it appears investors, at first blush at least, were very pleased with the outcome. Ticketmaster is up more than 16% year to date, but despite that, many analysts still have a strong buy rating, and the news overnight that it settled its US antitrust suit should give Live Nation potential momentum in trading tonight.